Chapter 4. Understanding the Past. But history is neither watchmaking nor cabinet construction. It is an endeavour toward better understanding. Mark Bloch. Whoever wishes to foresee the future must consult the past. Machiavelli. We can be almost certain of being wrong about the future if we are wrong about the past. G.K. Chesterton. The discounted cash flow and economic profit frameworks are ways of thinking about the value of a firm. We have seen in Chapter 3 that they are theoretically sound, as they are connected to what equity investors can expect to receive from their equity investments, that is, dividends. Yet capital markets in which equity investors make new and trade existing equity investments in firms are different to, say, the Sydney fish market. The Sydney fish market trades in fish which are delivered to you immediately and fresh. A fish might be swimming in the Pacific Ocean off Sydney's coast one evening, and it may be on a dinner plate in a townhouse in Sydney's Balmain the next evening. In a fish market, what you see is what you get. You get a fresh fish that is typically consumed quickly. By contrast, a capital market trades in expectations. Expectations are people's imaginings about things that have not yet happened. Indeed, expectations will typically be people's imaginings about things that will never happen, at least not exactly as people might think they will happen. Equity investment in a firm involves predicting the future. An equity interest in a firm is not like buying a dead fish in the Sydney fish market. Firms are alive, and we are buying outcomes of their future business activity. However, to predict the future, we need to start with the past. Machiavelli is a well-known Italian from the late 15th and early 16th century, who is probably most famous for his book The Prince, which provides pragmatic advice to leaders on managing the political process, that is, obtaining and maintaining power. He understood the importance of consulting the past as the basis for being able to foresee the future. The English writer G.K. Chesterton pointed out that if we fail to understand the past, indeed, if we are wrong about the past, we are unlikely to be able to predict the future very well. This chapter is about understanding the past of a firm. The importance of understanding the past is the insights this can give us to better predict a firm's future. We are going to use a firm's financial statements, along with other information, to help us understand the past. To do this as efficiently as possible, we are going to restate a firm's financial statements. This is to help us clearly identify the accounting drivers of a firm's economic profit and cash flows, including clearly separating a firm's operating and financial activities. After we have restated the financial statements of a few firms, it can become a mechanical process. Although, as many found when studying Act 11059, Accounting, Learning and Online Communication, the first time we restate a firm's financial statements, we may find it somewhat frustrating and time-consuming. Hopefully, this time in our unit, you will find restating your firm's financial statements a much more straightforward task, as you should now have a better understanding of what each item in your firm's accounts are and their accounting treatments. Remember the words about history from Mark Bloch, a French historian who was shot by the Gestapo during the German occupation of France in World War II for his involvement in the French resistance and for his Jewish ancestry. Like reviewing history, restating a firm's financial statements is an endeavour toward better understanding. It is not simply a task of putting together the financial statements in a different way, like putting together the parts of a watch or constructing a cabinet from various pieces of wood. It is a task we can do to make it easier for us to begin to understand a firm's past. We will then look at how we can analyse a key aspect of economic profit and cash flow, return on equity, ROE, by breaking it into bits: leverage, profitability, and efficiency. We will see how we can connect the accounting drivers of a firm's ROE with its economic and business drivers. This analysis is anything but mechanical. It requires us to engage with a firm's economic and business reality and is a subtle, creative, and active endeavour. In this chapter, we will gain some insights into how we can use a firm's financial statements to help us gain an understanding of a firm's past. Yet a firm's past is a trip already taken by equity investors. No one ever got rich simply by analysing the past. No one. Equity interest in firms involves us trading in expectations of an uncertain future. Yet, as Machiavelli has said 500 years ago, whoever wishes to foresee the future must consult the past. In this chapter, we will do just that: consult the past. 4.1. Abnormal earnings and restating financial statements. The most efficient way to ensure the key accounting drivers of economic profit and cash flow are appropriately identified is to restate a firm's financial statements in a way that ensures all earnings are included and that the operating and financial activities of a firm are clearly separated. In this section, we will look at abnormal earnings and why it is important to consider all the earnings of a firm when considering its value. We also review our understanding of the operating and financial activities of our firms. In section 4.2, we will look at how best to restate the balance sheet or statement of financial position and the income statement or statement of financial performance. We will not restate the statement of changes in equity nor the statement of cash flows. Accounting drivers. Abnormal earnings, AE, is an accounting measure of value add to equity investors. Another term for abnormal earnings is residual earnings, being the earnings left after the normal or required return to investors is deducted. In this study guide, we will use the term abnormal earnings rather than residual earnings. Both terms mean the same thing. We can express abnormal earnings, AE, as follows. AE equals return on equity minus ROE minus 1, all in brackets, times book value, where the drivers of abnormal earnings are return on equity, ROE, required rate of return on equity, ROE, and book value of ordinary shareholders' equity, BV. In 2022, Ryman Healthcare provided a return on equity of 23.0%. This compared to an estimate of its required rate of return on equity, ROE, of 9.4%. The book value of Ryman Healthcare's ordinary shareholders' equity at 31 March 2021 was $2,829.2 million. And this had increased to $3,434.5 million by 31 March 2022. If we use an average of Ryman Healthcare's opening book value at 31 March 2021 and closing book value at 31 March 2022 as an appropriate book value figure, we can calculate Ryman Healthcare's abnormal earnings in 2022 to be $425.7 million as follows. AE equals ROE minus ROE, all times book value, which equals 23.0% minus 9.4%, all in brackets, times 2,301.0 million plus $3,434.5 million divided by 2, which equals 13.6% plus $3,131.9 million, which equals $425.7 million. Ryman Healthcare's return on equity in 2022 was calculated as ROE equals comprehensive income divided by book value, which equals $638.8 million divided by 2,301.0 million plus 3,434.5 million, all divided by 2. It equals $720.1 million divided by $3,131.9 million, which equals 23.0%. Ryman Healthcare has 500 million shares on issue. So abnormal earnings of $425.7 million represents about 85.1 cents per share. This is not a bad amount of abnormal earnings to provide shareholders, given shares in Ryman Healthcare listed on the New Zealand Stock Exchange in mid-1999 at 27 cents per share, after adjusting for a 5-to-1 share split in January 2007. The actual share price on listing was $1.35. Equity investors who invested in Ryman Healthcare when it floated in mid-1999, which included my wife and 3 children, achieved abnormal earnings in 2022, that is, earnings greater than required to compensate them normally for the capital they had invested, of more than 3 times their original investment. A summary consolidated income statement for Ryman Healthcare for the year ended 31 March 2022 is included as Table 4.1. We can see from Table 4.1 that Ryman Healthcare's profit for the year was $692.9 million. Yet in the calculation of ROE, return on equity, for Ryman Healthcare above, we used comprehensive income CI of $720.1 million. To see how this earnings figure was calculated, we need to have a look at Ryman Healthcare's statement of comprehensive income for the year ended 31 March 2022. See Table 4.2. In this statement, we see other comprehensive income items that are included. Often, a significant item of other comprehensive income for Ryman Healthcare is revaluation of property, plant and equipment, unrealised. If we look at the summary of significant accounting policies and subparagraph D on page 99 in Ryman Healthcare's 2022 annual report, we will see that property, plant and equipment comprises completed care facilities, corporate assets and land, including long-term leases of land, and care facilities under development. These assets are revalued regularly using independent valuers. Any revaluation amounts are not included in Ryman Healthcare's consolidated income statement, but are transferred directly to Ryman Healthcare's asset revaluation reserve as part of its equity. The rise in the property values of Ryman Healthcare's care facilities, nursing homes and hospitals, corporate assets and land, head office assets, and retirement villages under development can be an important part of the added value it provides to its equity investors. In 2022, revaluations were zero, as no revaluations were made that year, and were $195.8 million in 2021. We include other comprehensive income in our figure for total comprehensive income, CI. We do this to include all of Ryman Healthcare's earnings or added value to equity investors, so as not to omit a part of the value of an equity interest in Ryman Healthcare. As noted above, a significant item in Ryman Healthcare's other comprehensive income can be revaluation of property, plant and equipment, unrealised. In Act 11081, Introductory Financial Accounting, we looked at how to account for property, plant and equipment. See these 3 short videos to review how we do this. Property, plant and equipment, what it is and how we turn it into an expense, depreciation. More property, plant and equipment, how we value it after we initially record it at cost, either the cost model or revaluation model. And then even more property, plant and equipment, how we value it using the revaluation model. If a firm uses the revaluation model to value some or all of its property, plant and equipment, then it will revalue these items to fair value periodically. How often it does these revaluations is a question of judgment by the firm. Ryman Healthcare uses the revaluation model for two classes of its property, plant and equipment: freehold land and buildings. The rest of its property, plant and equipment it values at cost. The key point here is that if we are to value a firm based on its earnings, we need to ensure we're including in our calculations all of its earnings, including other comprehensive income. Otherwise, we will be omitting some of the firm's value in our analysis. Restating the financial statements is a technical task that with practice can be done relatively quickly and easily, although there are a few traps we need to be careful to avoid. Remember, the purpose of restating the financial statements is to make our task of analysing the drivers of abnormal earnings more efficient. Restating the financial statements is essentially a task we do to save time and effort. When you do your very first restatement of firm's financial statements, you may find it a slow and frustrating task. As we saw when we studied Act 11059, Accounting, Learning and Online Communication, there are no shortcuts to doing it yourself and learning by doing. However, you should find it a lot easier to restate a firm's financial statements in our unit this time, having done it previously in Act 11059. And knowing a lot more about each of the items in a firm's financial accounts from your study of accounting at university. You should find restating your firm's financial statements a lot quicker, easier, and be reasonably mechanical this time around, if you have been learning about accounting for real in your degree. Statement of changes in equity. The statement of changes in equity shows how a firm's income statement and balance sheet interconnect. The bottom line or summary measure of the income statement is net profit after tax. The bottom line or summary measure of the balance sheet is the book value of ordinary shareholders' equity. The opening book value of ordinary shareholders' equity for a period, which is of course the closing book value of ordinary shareholders' equity from the previous period, plus the earnings for a period from the income statement and comprehensive income statement, should equal the closing book value of ordinary shareholders' equity after allowing for any cash flows between a firm and its equity investors, for example, dividends paid to equity investors and any share issues or share buybacks. We will not restate the statement of changes in equity nor the cash flow statement, as we will not use these two financial statements in our analysis of our firms. And we will now consider a way of thinking about a firm which clearly separates a firm's operating and financial activities. A conceptual view of a firm. Showing what doesn't matter can also show by implication what does. Merton Miller. As we saw in Act 11059, Accounting, Learning and Online Communication, a powerful way of viewing a firm is to clearly separate its operating and financial activities. This view of the firm is set out in Figure 4.1. A more detailed view is provided in Figure 4.1a, prepared by Rebecca Kirkpatrick, a previous student in Act 11059. The operating activities of a firm are its interactions with the product and input markets, with its customers and suppliers. These are shown in the left-hand side of Figures 4.1, 4.1a. These include decisions about which operating assets to acquire or sell, what agreements to make with employees, suppliers and customers, as well as various other activities to add value to the inputs a firm acquires from suppliers. The financial activities of a firm are its interactions with the capital markets, with equity and debt investors. These are shown in the right-hand side of Figures 4.1, 4.1a. These include decisions about the financial structure of a firm, how much of a firm's operations to fund with debt or equity, and matters such as dividend policy, how much of a firm's earnings to retain within a firm and how much to pay as dividends to equity investors. We can see the firm as comprising net operating assets, NOA, and net financial assets, NFA. NOA, net operating assets, are those assets net of liabilities that are used to produce products and services for customers in the product markets and earn operating revenue, OR, for the firm. Net operating assets are also used to acquire inputs for a firm's operations from suppliers in the input markets and incur operating expenses, OE. The difference between operating revenue and operating expenses is operating income, OI. Net financial assets are those assets, net of liabilities, that are used to store value and are not used in the operations of a firm. If a firm's financial obligations exceed its financial assets, its NFA will be negative, or in other words, it will have net financial obligations, NFO, rather than NFA. This is usually the case for most firms. NFA or NFO involve interactions with the debt and equity capital markets, namely net cash flows with equity investors, dividend payments, share issues and share buybacks, D, and with debt investors, net interest payments and the repayment and issue of debt, F. The transfers within a firm between its net operating assets and net financial obligations are its free cash flow, FCF, namely its cash flow from operations, C, less its net cash investment in net operating assets, I. A firm's free cash flow comes from its operating income, OI, less any increase in its net operating assets, delta, NOA. A firm's free cash flow less any increase in net financial assets, delta NFA, plus net financial income earned on its net financial assets, NFI, equals the net dividends, dividends plus share buybacks less share issues, paid to equity investors. Another way of saying this is that a firm's free cash flow is either used to increase its net financial assets, for example by repaying some debt, to pay interest on debt, negative NFI, or to pay cash to equity investors, D. In this way, free cash flow is a transfer of value between a firm's operating and financing activities. These relationships can be expressed as free cash flow equals operating income minus delta net operating assets, which includes the source of free cash flow. They can also be expressed as free cash flow equals delta NFA minus NFI plus D, which indicates the application of free cash flow, or in other words, where free cash flow goes. It seems clear that the operating activities of a firm can affect its value. But what about its financial activities? The Modigliani-Miller theorems form a central part of modern finance theory, as they address the question whether a firm's financial activities can affect the value of a firm. These theorems suggest situations where a firm's financial activities do not affect a firm's value one way or the other. With well-functioning markets and neutral taxes and rational investors who can undo the corporate financial structure by holding positive or negative amounts of debt, the market value of the firm, debt plus equity, depends only on the income stream generated by its assets. It follows in particular that the value of a firm should not be affected by the share of debt in its financial structure or by what will be done with the returns, paid out as dividends or reinvested profitably. Franco Modigliani. If the operation of our capital markets is largely efficient, then it generally would not be possible to add value to equity investors through decisions by a firm about how to finance its activities through debt or equity. If our debt markets are largely efficient, it would suggest equity investors in a firm can usually replicate the financial structure of a firm such as by borrowing against their equity investments in a firm on the same terms as a firm could borrow. If equity investors could borrow on the same terms as a firm, what value to equity investors would there be from a firm increasing or reducing its borrowings relative to the level of its equity? It would also suggest that equity investors are indifferent to whether they are paid dividends or receive a capital gain on the value of their equity investments in a firm. It would also suggest that tax rates are the same for a firm and all its equity investors. Although we live in a world of less than perfect capital markets, the debt markets in many Western countries are often quite close to being efficient. This means it can be difficult for a firm to add much value to its equity investors by way of its financial activities. Rather, it is through its operating activities that a firm primarily adds value. For this reason, there can be considerable value in clearly separating a firm's operating activities from its financial activities to help focus our analysis on those areas where a firm has the greatest potential to add value to equity investors. We will see in Chapter 6 the considerable benefits of focusing our analysis on the operating activities of a firm, or in other words, on the enterprise, rather than on the equity of a firm. In this section, we considered abnormal earnings as a measure of value add, and why it is important to consider all the earnings of a firm when considering its value. We also reviewed our understanding of the operating and financial activities of our firms, and have been reminded that a powerful way of viewing a firm is to clearly separate its operating and financial activities. In the next section, we will see how we can restate a firm's balance sheet or statement of financial position to clearly separate a firm's operating and financial assets and liabilities. We will also see how we can restate a firm's income statement or statement of financial performance to clearly separate operating and financial revenue and expenses. 4.2. Restate two financial statements. The two financial statements we will restate are the balance sheet or statement of financial position and the income statement or statement of financial performance. This section will review how we can do this. Balance sheet. To help separate the operating and financial assets and liabilities of a firm, we restate a firm's balance sheet. A balance sheet normally shows all the assets of a firm, both operating and financial, categorized as either current or non-current assets, and all the liabilities of a firm, both operating and financial, as either current or non-current liabilities. This way of categorizing the assets and liabilities of a firm can be traced to the influence of the banking sector in the early development of financial statements. It facilitates an assessment of the long-term and short-term liquidity of a firm. It does not help us to view a firm from the point of view of equity investors and to clearly distinguish between the operating and financial activities of a firm. Our purpose in restating the balance sheet is to clearly separate operating and financial assets and liabilities and to clearly identify net operating assets, NOA, and net financial assets, NFA, or more commonly, net financial obligations, NFO. You can see in Table 4.3 below how I have allocated assets and liabilities to operating and financial in Ryman Healthcare's balance sheet by placing an O or F next to each item of assets and liabilities. You will see we do not allocate equity items to operating and financial. Ryman Healthcare's balance sheet and its restated balance sheet are shown below in Tables 4.4 and 4.5 respectively. As can be seen from Table 4.5, the various assets and liabilities from Ryman Healthcare's balance sheet have been allocated between operating and financial activities. If we have a clear idea of the difference between a firm's operating and financial activities, this is in practice a reasonably straightforward exercise. Usually we can readily identify whether each asset and liability in a firm's financial statements is an operating or financial item. However, cash can pose difficulties. A firm needs some cash to conduct its operations. It will never be possible for a firm to exactly match its cash outflows, such as cash payments to suppliers, with its cash inflows, such as cash receipts from customers. For example, a firm may need to pay its suppliers on a Monday, and cash receipts may not come from customers until Wednesday that week. A firm will need some cash, either actual cash, for example in cash registers or cash balances in the bank, or an overdraft facility with a bank, to help the firm to manage the cash outflows and inflows of its normal business operations. However, a firm could also hold cash balances in the bank as a store of value that is not needed in the actual operations of the firm. In such cases, it would be a financial asset. Typically, it is not clear from a firm's financial statements how much of any cash balances are needed in the operations of a firm and are operating assets or operating liabilities if it is a bank overdraft, and how much of any cash balances are financial assets. Where a firm has a relatively low level of cash balances, my advice is to include these cash balances as an operating asset and assume they are needed to conduct a firm's operations. What amounts to a relatively low level of cash would depend on the nature of the firm's activities, but typically up to about 0.5% or 1% of sales might be an appropriate level of cash for a business to hold for the purposes of conducting its operations. Where a firm has a more significant level of cash balances, say more than 0.5% or 1% of sales, my advice would be to allocate an amount to operating assets, say up to about 0.5% or 1% of sales, and allocate the balance to financial assets. In summary, to restate a firm's balance sheet, we go through each item of assets and liabilities and allocate them as being either operating or financial. This is generally straightforward, as we usually have enough information in a firm's financial statements to do this. The only difficulty that usually arises is in relation to cash. We will usually need to make some assumptions about how to best allocate a firm's cash balances or overdraft facility between a firm's operating and financial activities. Once we have restated a firm's balance sheet, we will have clearly identified its net operating assets, NOA, and net financial obligations, NFO, or net financial assets, NFA. For example, we can see from table 4.5 above that Ryman Healthcare, as at 31 March 2022, had net operating assets of $6,015.3 million and net financial obligations of $2,580.8 million. Income statement. Our purpose in restating the income statement is to clearly separate operating and financial revenue and expenses, and to clearly identify operating income after tax, OI, and net financial expenses or net financial income after tax, NFE or NFI. Ryman Healthcare's income statement and statement of comprehensive income are shown in tables 4.1 and 4.2 above. Ryman Healthcare's restated income statement is shown in table 4.6 below. You can see in table 4.7 below how I've allocated revenue and expenses to operating and financial in Ryman Healthcare's income statement and statement of comprehensive income by placing an O or F next to each item of revenue, expenses, and other comprehensive income. A firm will report one figure for its tax expense in its income statement. Tax is a real expense of a business in the same way as any other expense, such as salaries, rent, or fuel for the corporate jet. In Australia and in many other countries, interest expense is generally tax deductible for firms. A firm's financial activities, such as its level of borrowings, will influence its interest expense and its tax expense. For example, increasing a firm's interest expense will reduce its tax expense. This means a firm's tax expense will be affected not only by its operating activities, but also by its financial activities. To clearly separate a firm's operating and financial activities in its financial statements, we need to allocate tax to a firm's operating and financial activities. To do this, we need to calculate the tax benefit or tax shield to the firm of its interest expense as follows. Tax benefit equals net interest expense times T, where net interest expense equals interest paid less interest received. T equals the tax rate of the firm. The corporate tax rate in Australia is 30% for larger companies, and in New Zealand is 28%. Add the firm's tax benefit to its tax expense and deduct this total amount from a firm's operating income. This will give a firm's operating income after tax, without including the impact on its tax expense of any level of debt financing. In other words, it will be its operating income after tax as if the firm had no borrowings and had no reduction in its tax expense or tax shield from the tax deductibility of its interest expense. Add the firm's tax benefit to its net financial expenses, NFE. This will give a firm's net financial expenses after tax, after attributing to its financial activities the tax benefit of these activities. In this way, net financial expenses after tax would generally be higher than net financial expenses before tax, the difference being the tax benefit. The steps to restating a firm's income statement and statement of comprehensive income are: go through each item of revenue, expense, and other comprehensive income and allocate them between operating and financial activities. This is usually straightforward, as we typically have enough information in a firm's financial statements to do this allocation. Allocate tax to the operating and financial components of the income statement. Calculate both a firm's operating income, OI, and its net financial expenses, NFE, on an after-tax basis. I have carried out these steps for Ryman Healthcare in Table 4.6 above, calculating a comprehensive operating income after tax, OI, of $713.6 million, a net financial income after tax, NFI, of $6.5 million, and a comprehensive income, CI, of $720.1 million. We've reviewed how to restate a firm's financial statements to clearly identify its comprehensive earnings after tax and book value of ordinary shareholders' equity, BV. It also clearly separates the operating and financial activities of a firm, along with an estimate of a firm's cost of capital, which we will discuss in Chapter 7. We are able to readily calculate a firm's past abnormal earnings. We also have the financial statements in a form that will assist us to identify the drivers or reasons why a firm has been able to generate abnormal earnings in the past. In other words, we are ready to start analysing the financial statements by breaking things into bits.